Hi, I'm Art Sukazian with NCUCA, the president of this organization designed to serve your educational needs on a national level. Today we went through quite a bit of content that included AI, included lending strategies, automated efficiencies, to name a few, collections strategies, and also texting payments. Texting payments became a hit in our session today during our joint case study session with MessagePay's CEO, and we had a lot of questions and activity on this topic. But what I'd like to take you into is just a quick overview of some of the topics that we did cover and some of the profound outcomes and some of the sound bites that our speakers have to share with you today.
So the one takeaway is from this my talk that I gave is the economy, there is like tremendous uncertainty coming out of policies, mainly policies, trade war, immigration, tariffs and all of that. Consumers are at the center of this, and it is really hurting consumer sentiment. That will have repercussions on consumer-oriented businesses, and credit unions are one of them. So just be on the watch, look out. The data is not yet capturing all of this because many of the data is lagged. So please look at forward-looking metrics to see if the consumer is feeling under stress. You will see that reflected in your businesses. While not predicting a recession for the coming year, we are predicting a slowdown in the economy.
I'm James Aiken. I'm head of regulatory advocacy at America's Credit Unions. So I'm an attorney, and I lead a team of attorneys that advocate and lobby the executive branch of the federal government, so agencies like the NCUA, CFPB, and others. And today I was giving an update to NCUCA about what's going on in Washington, D.C., which is a lot right now. We have a new presidency, a new Republican trifecta, so President Trump in the White House, Congress, both Senate and House, led by Republicans, and they are leading a charge to push President Trump's agenda right now. There's a number of different ways that's impacting credit unions, but the most important one for us is the taxation status of credit unions. So we have seen a push during this new tax reform push to go after credit unions' tax exemption, and that's something that's incredibly important for us to protect. And we're working with Congress and the regulators to ensure that everyone understands why it's so important for credit unions to be tax exempt. Beyond that, we're working very closely to develop relationships with and push our priorities with the new heads of the regulatory agencies. So at the NCUA, that's Kyle Hautman. At the CFPB, that's going to be Jonathan McKernan. And making sure that during this time of transition where there's a deregulatory focus from the agencies, that they understand ways that deregulation can help credit unions and also provide credit unions with the ability to offer products and services and serve their members in the way that they best know how. Within that, there is a bit of uncertainty as President Trump is moving fast and furious with his executive orders. He's doing a lot to expand his authority over independent regulatory agencies like the NCUA and the CFPB. We still look to see how that's going to play out, but for now, there's a freeze on all rulemaking. There is a move from the agencies not to defend litigation against them for lawsuits that they're undergoing as a result of rulemaking. And there's going to be massive, it looks like, reductions in the staffing and size of some of these agencies. The NCUA is going to see reductions in force, but we're also likely to see the CFPB dramatically changed. And the question becomes whether that is the statutory requirement of it being 5 guys in a room with a phone, or whether it's something a bit more compromised where we have a 5-member or 3-member bipartisan board and they are subject to appropriations. But that's an open question and something we continue to have conversations on.
So today we wanted to talk a little bit about how technology could potentially enable future-ready collection strategies, right? So the idea of my talk was, how could credit unions take lessons from the origination space, which has been doing things a little more proactively than collections, how we could take lessons on what we learned in the origination space and apply them to collections to enhance customer satisfaction, increase empathy, things like that. So my talk was more so about how credit unions could leverage technology and best practices to enhance their collections operations. So we really wanted to talk a little bit about three main pillars, right? The first one would be to lean into data-driven and AI analytics, right? There's a lot out there that credit unions could potentially leverage to make things easier to collect, right? Again, there's a ton of vendors out here that provide those capabilities, so we wanted to talk a little bit about how we could bring fintech into the equation. Talk a little bit about AI and how that could enhance models that would allow debtors to more effectively collect. And then finally, we wanted to talk about omni-channel capabilities. Omni-channel being cross-channel capabilities. So typically, credit unions would be dialing for dollars or reaching out to their members to get them to repay overdue or delinquent loans. So recently, Temenos has launched a digital self-service portal to allow credit unions to go ahead and proactively reach out to a potential member that might be delinquent on an account, to help them readily and easily go ahead and remedy that issue, right? Without having to have an uncomfortable conversation with a credit union representative or have to visit a branch, right? So the idea of bringing self-service channels to the collection space is a major key that we wanted to talk about today as well. So yeah, there are multiple vendors out there that kind of do what we do in the collection space. The one key differentiator, I think, as Temenos, is that we're a large company. We've been in the collections business for over 20 years here in North America. We've got 400 customers, and we don't just do collections. We've got account and loan origination capabilities. We've got digital onboarding technology. We sell a banking core. So we provide a breadth of solutions for the folks in the credit union space. So I think we bring a unique perspective in collections, right? So we wanted to come here and talk about our collections offering, and then obviously some of the enhancements we've done, specifically providing that self-service portal for credit unions. I think really what I wanted to position and what I wanted to talk about today were some best practices that credit unions could use to enhance their collections operations, right? So really that was kind of what I wanted to drill home, and hopefully I was able to do that and advise the credit unions out there in the audience. I think the big thing would be to lean into fintech and lean into AI to go ahead and optimize the collections operations, right? So go ahead and do that. And then with that, with the addition of our self-service collections module, I think credit unions could really go ahead and transform how they collect today.
I've been working with credit unions and community banks since the mid-90s. Started out with just doing investment and balance sheet related work, but it quickly morphed into strategic advisory. And there's never been a more interesting time to be in strategic advisory for credit unions and banks than today, because so much has changed so fast. And that's kind of the gist of the whole discussion that we're having with credit union and bank boards and the C-suites. I'm with Strategic Resource Management, and both myself and the company are very focused on providing fact-based research that leads to a more vibrant understanding of what's going on in the business, what's being done to the business by things like the industrial revolution of technology on life as well as banks and credit unions, which has had a monstrous effect on earnings and the ability to compete, because the institutions with scale have the ability and the finances to invest in technology, and they're using that to get new members and new loans and new deposits. But the banks and credit unions are not without answers, but the whole future depends on understanding what's gone on, why it's happening, what the trends look like, and from there make more informed decisions about how you're going to put your precious resources against the business. And your precious resources are your people, their time, capital, and focus. So think of it this way. If a company's going to grow, and the purpose of a company is to get new customers, because that means you're satisfying your current customers and you're getting more. Well, if that's going to happen, you need to be able to invest in that. But what we're hearing from our clients is banks and credit unions start every day understanding that they have anywhere from 10 to 15 mission critical things to do for their customers, but they only have the resources to handle 3 to 4 a year, which means they're 5 years out in getting all those mission critical things done. And in that process, more will come in. And that's really what's been going on since the turn of the century, technology. And so we're talking to them about how to speed up and get to market on mining your current customer member base for new business. You currently have members who have a checking account with you, but they don't have their mortgage loan with you, or they have a CD, but they don't have checking. There are ways to get at that business that makes it more efficient and pay off more in terms of growth and more profitable growth. And although credit unions are not for profit, banks are for profit, credit unions need profit because they need to take that money and invest in more of what the member needs. So it all feeds off of each other. So we speak in terms of what I call the three-legged stool of strategy for banks and credit unions, and that's to be better than most at organic growth, get better than most at productive merger, and then be selective and figure out who and how to partner with fintechs, because some fintechs are not competitors. And that three-legged stool, we believe those that are the best at that are going to be the happiest 5 years from now.
Karan Kashyap, I'm the co-founder and CEO of Posh AI. We're a Boston-based conversational AI company, and we work with credit unions helping them use AI technologies for different applications like member service and employee efficiency. Yeah, so the presentation topic was around generative AI for credit unions and how they could think about technology both from a promise and reward standpoint, but also from a pitfall and risk standpoint. And so we really focused the presentation around, first of all, like explaining how quickly the industry is moving with AI, not just the banking world, but just the whole world in general, how quickly AI technologies are kind of evolving and progressing. We then talked about a little bit about what's the technology building blocks, like what does it mean to have a generative AI model? What does it mean to have a large language model, and how do they work? And then we looked at different applications of the technology in the credit union world. Some things that Posh is doing ourselves, some ideas of things that we're seeing credit unions exploring in general, even maybe beyond what Posh is doing too. But just to kind of get people to kind of understand that, hey, this technology has applications in so many different aspects of how a credit union might operate and how their business processes work. So one example is how AI can be used within the contact center environment, right? How can we use AI for voice agents and chat agents? How can we facilitate people making payments through those channels? We then talked about AI for search. It could be a member-facing search. It could also be employee search. A lot of credit unions have policies and procedure documents, for example, and usually it's not an easy process to search that information and get what they want. But large language models and generative AI are really making that process much more efficient and much more accurate as well. We talked about how AI could be used specifically within collections as well, both from actually helping to personalize outreach, helping to actually predict potential delinquencies, but also to be used for training purposes as well. If you have collection staff and they're new hires, for example, and you're wanting to help them understand what it's like to have different scenarios of conversations, you can actually simulate different environments using AI as well. So in 5 to 10 years, AI is changing so fast. We're seeing every year that whatever happened last year is now 10 times cheaper, and things have progressed so much, right? So we're really on an exponential curve with this technology. I think we're going to see a lot more personalization. I think we're going to see a lot more one-to-one service as opposed to one-to-many service. And what I mean by that is, every credit union's goal is to have a true VIP experience for every member. But it's difficult to do that in practice because you only have so much staff and you have so many more members that having that one-to-one relationship just really isn't feasible. I think with AI, that becomes much more feasible. You start thinking about, where do we unlock our humans to really spend their time, but also how do we, keep using the benefits and evolution of AI to provide a more personalized relationship and more personalized engagement, even from the AI standpoint as well. So I'm really excited for that future. It's hard to predict what's going to happen in 5 to 10 years, though, just because things are changing so fast. But I think there's a lot of use cases for this technology that I can already see in this market. I think in the next couple of years, we'll see a lot of credit unions really modernizing a lot of their processes and use cases using AI technology.
I'm Greg Pesce. I'm the CEO of MessagePay. And today I had a chance to meet with Art Sukazian and present on text payments and what they can do to help with delinquencies and with self-service and efficiencies in collections. The way it works is this. We send a message via text to the member, making them aware of the fact that they can make payment on their loan through this text. This text looks just like the actual credit union, has the same look and feel, and then the borrower, the member, has the capacity then to just tap the screen and say pay and make their payment. Having done this with LAFCU, as this particular example, we were able to show what impact these text messages have on delinquencies and on the ability to get more payments on time through a self-serving mechanism. And the numbers are fairly striking. The benefits include, number one, increased number of payments. Number two, a reduction in delinquencies. And number three, a reduction on the impact on calls, like the total number of calls that are received by the credit union. So at the same time that payments numbers go up, delinquencies go down, and the number of calls go down, LAFCU has found this to be a winning formula. I'm a 25-year payments professional, and what I've done for the last 25 years is to find ways to make it easier for financial institutions to communicate with and receive payment from their customers. So in today's session, we outlined how that can actually happen using text messaging. So the text messaging process that we have allows for the following. One, the borrower is able to make payments right through their phone in real time. Two, that is also linked to the back-end core. So these are not just payments that are coming in via the phone, but they're real-time payments that get updated into the banking core in real time, which facilitates the movement of money and actually also facilitates the ability for these people, for the customers, to make their payments in a timely fashion.
Hello, I'm Bob Child, Chief Operating Officer with Origins, the credit union service organization that supports over 1,700 credit unions for their auto lending in the industry, connecting to 20,000 different car dealers that are out there. During 2024, we helped credit unions process approximately $58 billion worth of auto loans. What's interesting, and let me just kind of go backwards a little bit, in 2022, credit unions peaked on new car auto market share. That was an interesting time for car buying. During that time, car buying, consumers were paying and members were paying over MSRP because of the chip shortage. Also, interest rates were at a record low, and credit unions took advantage of lending to both members and new potential members that were out there at the time, and picked up a lot of market share. Unfortunately, as we go into 2025, as we think through this, a car owner holds a car for typically 2.6 years. That's the average loan life that's out there. And we fast forward to today, and when those members purchase their cars above MSRP, even with the low interest rate, unless they were paying it down aggressively, they're in what is referred to as a negative equity position today. And we're seeing more negative equity that's happening out there in the marketplace. And what does that mean for credit unions? It means that our members are now purchasing their next vehicle and they're putting $2,000 or more of unpaid loan from the previous car onto the new car. So that loan to value ratio is going way up, and it's stressing the consumer and the member. Now, that typically wouldn't be so bad, except for the fact that it's kind of complicated right now by the fact, and I'm sure everybody out there understands, that your auto insurance has gone up on your car 12% year over year. Your homeowners or your renters insurance has gone up 21% or more year over year. And when you look at household goods, even from your eggs on up, that has gone up dramatically. What does that all add up to? It adds up to the fact that our members are seeing $120 a month in additional costs onto their personal income statement that they didn't see a year and a half ago. And so when we take a loan, a car loan, a new car loan, and then you layer on the additional costs from the previous car loan and now add on to that these additional costs from the auto insurance, homeowners insurance, and costs of goods, you see the strain on our members that's out there. And we're starting to see it show up in the delinquency factor. And so it's something to watch out for. And one of the things in our presentation that we talked about today was the fact that some of the watch items are, in this particular segment, negative equity. So look for your members that have negative equity, one, and also then two, look for your members that are stretched, meaning that when you look at what their debt to income ratio is, be cautious how much additional debt they're taking on. The third thing that we talked about as it relates to auto loans and delinquency is student loan debt. 2.5 years ago, under the Biden administration, many of our younger members that have student loans expected that they were going to get student loan payment relief. And so they stopped paying a lot of those student loans. You fast forward today, underneath the Trump administration, it does not look like there is going to be that student loan forgiveness. And so now you've got another $120 or so of student loan debt, which is coming back onto that personal income statement of our members. And so it's putting pressure out there. And so when we see things like the consumer confidence coming down, when we see a little bit of rise in delinquency, you'll understand all the different factors that are at play, and you understand what our members are dealing with. The next concept that I would just quickly go over is that of the changing auto buying experience. And so as a baby boomer, I purchased all my cars through a car dealer, but those days are changing. So we've got EV cars like Tesla, Lucid, Rivian, where you just buy the car online, and it is basically like a 3-click experience that our younger members really appreciate. And so it's a growing trend, and we're starting to see Amazon get into auto lending as well. They're going to start to explode this whole space. Couple things. What does this mean for credit unions and our members? Couple things. One is we recognize that credit unions have the best interest rates for our members. We have the lowest auto interest rates that are out there, and we have to do them a service by educating them and being at all these different online locations that are out there to make sure that they're pre-approved for that auto loan, that they do not get forced into a bad interest rate loan from somebody else. And so this is particularly true. The highest demographics of car buyers right now are Gen X and millennials. It's no longer the baby boomers. And so these are generations that grew up on the internet, and as a credit union movement, we have to serve them on the internet, and we have to figure out how we work as a collective to do it. Lastly, as it relates to this on the internet, when a member is coming into your bank branch, the likelihood of fraud is much lower than somebody shopping behind a wall online. And so we're starting to see more and more fraud happening from these online channels. And so as a credit union, we want to be able to serve our members, particularly the millennials, the Gen X, where they're at, but we also have to pay particular attention to how we are going to basically laser through and identify the fraud early. And sometimes it's going to get through, but once it gets into that delinquency and that collection, if there's that missed first payment, that's a red flag that it could be a fraud situation and something that we need to look at. And so, not the most positive thing, but the world is changing out there. Artificial intelligence and online, it's the wave of the future, and it's coming. It's what our members want, and we have to be there and prepared to serve them. So that's my speech, and look forward to seeing you next year.